Well, it's always a pleasure to be at IIE because I've really admired what Fred Bergston has done with this institution. I think it has a rare combination of doing first-rate research, but doing so in a policy timely way, and I think its effectiveness is very well known. I also am very glad to have Nancy Birdsall here. I know the Center for Global Development has been a very good partner of both IIE and also for us at the World Bank. So I really appreciate all of you taking time to be with us today. So how will people in 2018 look back on this year? It depends on what we do. September was a hard month in a precarious year. A meltdown in financial, credit, and housing markets, the continuing stress of high food and fuel prices, anxieties about the global economy. Over the past year, most developing countries grew robustly despite the turmoil. In fact, major developing countries powered an alternative engine of growth. In 2007, they averaged a record 7.9% of GDP growth, and in 2008, perhaps a still impressive 6.6%. But this is not shared by all. Soaring food and fuel prices are plunging the most vulnerable into a danger zone. People are hurting. Families are worried about what the coming days will bring. The events of September could be a tipping point for many developing countries. A drop in exports as well as in capital inflows will trigger a fall-off in investments. Deceleration of growth and deteriorating financial conditions combined with monetary tightening will trigger business failures and perhaps banking emergencies. Some countries will slip toward balance of payments crisis. And as is always the case, the most poor are the most defenseless. While American eyes are on the intersection of Wall and Main Streets, there's much more to the story. The response to these crises will have to be larger and global. Voices around the world are blaming free markets. Others are asking about the failure of government institutions. Many will point at the failings of the United States as the architect of today's global economy. We cannot turn the clock back on globalization, nor can we let the crisis of today blind us to the opportunity of tomorrow. We must learn the lessons from the past as we build for the future. We must modernize multilateralism and markets for a changing world economy. Ours must be a globalization where both the opportunities and the responsibilities are more widely shared. Without that, we may design a new architecture, but it will turn out to be a house of cards. Multilateralism, at its best, is a means for solving problems among countries, with the group at the table willing and able to take constructive action together. I'm a mechanic in multilateralism. For over 20 years, I've been involved in trying to make the international system work. Next week at the Bank and IMF annual meetings, I will turn to the implications of the last 12 months for the World Bank Group. But today, with a crisis in progress and an election within weeks, I'm going to sketch a larger drawing. To understand today's crisis, we need to consider what has happened over at least the last 20 years. Today's globalization and markets reflect huge changes in information and communications technology, financial and trade flows, mobility of labor, worldwide interconnectivity, the death of distance. But even those transformations do not capture the biggest change. Over the past 25 years, the world market economy has grown from about 1 billion to 4 to 5 billion people. This is an amazing increase in a relatively short period. The competition of globalization, the huge expansion of the global labor force, and relatively low commodity prices combine to create something else, a golden era for central bankers. The price dampening effects of these shifts made central bankers look like technocratic wizards, and we liked their magic. Loose monetary policies and abundant liquidity led investors to chase yield and one another. Investors lent and leveraged against seemingly ever-rising asset values without attention to credit risk, earning power, cash flows. Investors did not plan to hold the assets long enough to wait for the earnings. And even when they did, the investor share was supposedly guaranteed by assurances backed by those same high asset prices. With the burst of the internet bubble and Japan's long real estate and banking crisis, the liquidity deluge slipped over to developing countries, especially those whose currencies were pegged to the dollar. Commodity prices fell with the collapse of the Soviet Union, leading to underinvestment, especially in oil and metals, and then rose dramatically as developing economies hungered for inputs. Food and fuel became increasingly linked, both because the share of energy used in food production and transport increased, and consumers of food and energy have become competitors. A food for oil crisis in the making, and this year we saw it erupt. The higher prices could push some 100 million people in developing countries back into poverty. We risk a second round of inflation, balance of payments crises, and tight budgets. The sources of international capital pools have been shifting too. The commodities boom, especially for energy, led to huge returns, ending up in sovereign wealth funds. Burnt by the trauma of 1997-98, some developing countries resolved never to risk that anguish again and managed exchange rates to create immense reserves. These savings seeded other sovereign funds. Changes in labor force, financial liquidity, commodity markets, and sovereign funds reflect an even more significant transformation. New economic powers are on the rise. The engagement of rising powers with the global economy has made them stakeholders in the global system. These rising powers want to be heard. They want to know what their role in making the new rules for the global economy will be. Having demonstrated their competitive success, these rising powers are suspicious that the more established stakeholders will hold them back, whether due to old rules of trade and finance or new rules for climate change and the environment. The developed economy stakeholders, in turn, both benefit from and are threatened by the changes. Rising developed economies offer multiple poles of growth that assist their recoveries and offer new possibilities. But they also serve as fodder for scaremongers. Indeed, with growth rates averaging about 6.6% between 1997 and 2007, some 25 countries in sub-Saharan Africa, with almost two-thirds of the region's population, offer a vision of yet another pole of growth that might be developed over coming decades. This could be a great achievement, not only for overcoming poverty and for development, but also for freeing untapped talents and energies. But it will be an achievement left unrealized unless we have the vision and courage to stand up to the challenges of economic isolationism at home and to offer the leadership to help make it happen. The financial and economic pains and fears will reinforce a tendency to pull back. Some feel that the rules of the game, dealing with bailouts, exchange rates, trade, immigration, and foreign aid, leave them out, even if people with higher incomes seem to be able to take advantage of the changes. The old safety nets to help people adjust to these changes are woefully out of date. This agenda, not just the aftermath of financial rescues, must be seized by new leaders. The events of this year are a wake-up call. There are storm clouds over multilateralism and markets. As food prices soared, agricultural markets started to break down under political pressures. Some 40 economies imposed bans or restrictions on exports of food. Others imposed price controls, broke contracts, halted trading. The UN strained mightily to get countries to double their contributions to food assistance for those most in need. Poor nations struggled to get seeds and fertilizers to farmers. Poverty, hunger, and malnutrition increased. As the global system for agriculture ran aground, the World Trade Organization drifted into dangerous waters. The Doha round has hit the rocks. The climate change negotiations, organized under the UN Framework Convention on Climate Change, will be made more difficult by Doha's discord. And under the best of circumstances, this negotiation will be an uphill struggle. Furthermore, the cap-and-trade climate change bill that failed in the Senate this year points to the next challenge for multilateralism and markets. To avoid putting industries subject to carbon caps at a competitive disadvantage, the bill invoked trade protections against exporters that did not face carbon limits. While needs are growing, the international aid system is not keeping pace. Donors bring ideas, energy, and resources, but they also overwhelm national ownership by developing countries, harming the effectiveness of aid. In 2006, there were more than 70,000 aid transactions with an average project size of only $1.7 million. Last year, the average developing country hosted 260 donor visits. Vietnam had 752. National governments are drawn increasingly to provide aid with their flag, not through multilateralism that encourages coherence in building local ownership. And even so, the G7 as a whole is far behind its Glen Eagles commitments to boost development assistance. Private financial markets and businesses will continue to be the strongest driver of global growth and development. But the developed world's financial systems, especially in the United States, have revealed glaring weaknesses after suffering titanic losses. The international architecture designed to deal with such circumstances is creaking. Perhaps the most striking change since my experience at the U.S. Treasury in the 1980s is the loss of fortunes of the G7. This group once played a valuable role in coordinating policy, with agreements such as the Plaza and the Louvre Accords. But the economic summits long ago placed a priority on ceremony over policy. I still harbor hope that the meetings of finance ministers will offer a multilateral navigator in dealing with global financial and economic problems. But the forum falls far short of the need. Even as the United States and the world dig out of the present hole, we need to look further ahead. We need a new multilateral network for a new global economy. The Bretton Woods generation left two legacies. First, international institutions and regimes in various states of service and repair. Second, and more important, that generation left an intellectual, policy, and political commitment to act multilaterally to turn the problems of an era into opportunities. Some are calling for a 21st century approach, but many are falling back to 20th century models. The new multilateralism, suiting our times, will need to be a flexible network, not a fixed nor unitary system. It needs to manage and maximize the strengths of interconnecting actors and institutions, public and private. We have seen that the more adaptable national economies handle the inevitable shocks and changes most effectively. Applying that experience, the multilateral system needs to build in flexibility. It also needs to use markets and incentives for private sector organizations and individuals, profit-making, and civil society NGOs. The new multilateralism should be respectful of state sovereignty, while at the same time recognizing that many issues do not respect state borders. This new multilateral network needs to be pragmatic. Its baseline work is to foster cooperation by encouraging exchanges of perspectives on interests, both domestic and international. Often just sharing information is a good start. Then we should encourage a search for mutual interests. Sometimes mutual interests can be fostered with incentives, and international institutions can become catalysts for action. Practical problem solving builds a culture of cooperation. Our new multilateralism must build towards a sense of shared responsibility for the health of the global political economy. This means, chiefly and critically, that it must involve those with a major stake in that economy, those willing to share in responsibilities along with the benefits of maintaining it. We must also redefine economic multilateralism beyond the traditional focus on finance and trade. Today, energy, climate change, and stabilizing fragile and post-conflict states are economic issues. They're already part of the international security and environmental dialogues. They must be the concern of economic multilateralism as well. The new multilateralism will depend principally on national leadership and cooperation. Countries matter. The G7 is not working. We need a better group for a different time. The G20, though valuable, is too unwieldy in moving from discussion to action. We need a core group of finance ministers who will assume responsibility for anticipating issues, sharing information and insights, exploring mutual interests, mobilizing efforts to solve problems, and at least managing differences. For financial and economic cooperation, we should consider a new steering group, including Brazil, China, India, Mexico, Russia, Saudi Arabia, South Africa, and the current G7. Such a steering group would bring together over 70% of the world's GDP, 56% of the world's population, 62% of its energy production, the major carbon emitters, the principal development donors, large regional actors, and the primary players in the global capital, commodity, and exchange rate markets. But this steering group would not be a G14. We will not create a new world simply by remaking the old. It should be numberless, flexible, and over time it could evolve. Others may be added, especially if their rising influence is matched by a willingness to help shoulder responsibilities. The new steering group should meet and video conference regularly to foster group responsibility. The deputies should have frequent and informal discussions. An active network of bilateral consultations within and beyond the group will support it. We need a Facebook for multilateral economic diplomacy. The IMF and World Bank Group, perhaps with the WTO, can help support this steering group. We can identify emerging problems, supply analysis, suggest solutions, and draw on our own broader membership to propose coalitions to address issues. The steering group will still need to work through established international institutions and regimes, which include other states. Sovereignties will be respected. But the core group would increase the likelihood that countries can draw together to address problems that are larger than any one state. We need this mechanism so that countries are not left to fail with all the human, economic, and political consequences that this entails for them and for their neighbors. We need it so that global problems are not just mopped up after the fact, but anticipated. We need it to develop the habit of dialogue and the necessary relationships of trust before the crisis hits. We need it to shape multilateral solutions. We've seen the dark side of global interconnectedness. We have to navigate towards the light. The first task will be close to home. Next year, there will be a major effort in the United States to overhaul the failed system of financial regulation and supervision. We must ask why so many thoroughly regulated and supervised institutions got into trouble. Any risk-based model, no matter how sophisticated and well supervised, depends critically on the assumptions. What happens when the assumptions fail? The changing conditions that trigger failure will be increasingly dependent on shifts in the world economy. Just as this crisis has been international because of interconnectedness, the reforms will need to be multilateral. The Financial Stability Forum, ably chaired by Mario Draghi of the Bank of Italy, has started to tackle these issues. But the FSS concentrates on OECD economies. Whether through an expanded FSF, a stronger SFF-IMF linkage, or the steering group, these financial supervisory issues will need to be addressed in a broader multilateral context. We must bolster an IMF early warning system for the global economy, focused on crisis prevention, not just crisis resolution. September's financial shockwaves in the United States are reverberating in the global economy. The stark reality is that developing countries must prepare for a drop in trade, capital flows, remittances, and domestic investment, as well as a slowdown in growth. Countries with sound fiscal and balance of payments positions should be encouraged to spur domestic demand through consumption and investment. But others have little fiscal space, risky current account deficits, balance of payments problems, financial danger, or all four. The fund and the development banks will need to assist. For some larger countries under threat, the steering group and friendly countries should act in concert with the fund and the bank to offer support linked to policy reforms that will return the country to sustainable growth. The IMF must also have an ongoing role in the world's exchange rate system, beyond surveillance. As Jean Pisani-Ferry wrote recently, a large part of the developing world is not yet ready for independent floating of their currencies because of incomplete financial liberalization and anxieties about uncontrolled adjustment. The IMF, backed by the steering group, can offer more options, including pegs linked to currency baskets or commodities. Over time, we need to prepare for an international finance system with multiple reserve currencies with others connected by various pegs. The new multilateralism must put global development on a par with international finance. Until we build a more inclusive globalization, the world will remain unstable, no matter how big the financial rescue packages. Economic multipolarity offers stability and opportunity, just like a diversified portfolio of investments. But to boost more inclusive and sustainable growth, we need to think about aid differently. 2 weeks ago, at the United Nations, international partners raised $16 billion for development projects. This money is vital, and we need more if we're going to be able to reach the Millennium Development Goals. But we also have to broaden our approach. We must listen to the growing number of Africans who are telling us they want markets and opportunities, not aid dependency. Private capital and markets will remain the drivers of growth. We must look beyond projects and programs to new ways of doing the business of development. We need innovative instruments and intermediation to help connect sovereign wealth funds to equity investments in Africa, build local currency bond markets in emerging markets, manage development risk through insurance facilities for weather and catastrophic events and to help small farmers, to demonstrate the viability of public-private financing partnerships to develop infrastructure, and broaden types of assistance from advanced commitments to develop life-saving pharmaceuticals to debt or rate buy-downs. While we build markets and institutions for the medium and longer term, the new multilateralism needs mechanisms to move much more quickly and effectively to help those who are most vulnerable when the crisis hits. One example is the World Bank's new $1.2 billion rapid financing facility for those endangered by high food prices. Another example could be the reform of humanitarian food assistance. With a modest modernization of donor support to the World Food Program, such as core or multi-year funding and a credit line, we could apply financial market tools to help the World Food Program manage liquidity, market, and operational risks. Working with the World Meteorological Organization, the WFP and the bank could better prepare, cut costs, and respond more quickly. We also need a worldwide agreement not to apply food export bans or prohibitive taxes to humanitarian purchases, as well as an agreement to release national reserve stocks should an excessive price increase occur due to hoarding or speculation. We need political leadership to break through old bureaucratic models. The World Bank Group must also adapt more quickly to meet new needs of its clients and the interests of its shareholders. We need to better align our governance to the realities of the 21st century. To look beyond our initial steps for changing voice, representation, and responsibility, I will assemble a high-level commission to consider the modernization of World Bank Group governance so we can operate more dynamically, effectively, efficiently, and legitimately in a transformed global political economy. And I'm delighted that Ernesto Zedillo has agreed to lead this work. I've asked Ernesto to work with colleagues looking at similar governance issues at the IMF. In 1944 at Bretton Woods, the founding fathers of economic multilateralism seized a moment to build a better future. We must be no less ambitious today. The Doha global trade negotiations in the WTO are now gasping on life support. It's vital that the WTO and an open global trading system not be buried with them. Trade negotiations will continue elsewhere. Recent research has shown how FTA negotiations can support broader opening of markets. But FTAs and preferential arrangements that are not broad-based could weaken global liberalization. They need to be linked to global disciplines. And the multilateral system remains the only option for lifting the heavy hand of trade-distorting support for agriculture, still running at some $260 billion per year. Litigation in the WTO creates winners and losers. If not balanced with win-win negotiations, a WTO only associated with litigation will lose support. WTO members will need to consider how to continue to foster global liberalization. One option is to shift trade facilitation from a negotiation to a development plan. There are opportunities to cut costs of trade far in excess of those imposed by tariffs and other trade barriers. The World Bank's Doing Business, Trading, and Logistics indicators offer a good diagnostic framework. Regional bodies such as APEC have pointed the way in practice. We can help countries simplify and harmonize procedures and documentation across the supply chain. Countries can apply risk management techniques to border inspection and customs clearing, backed by electronic processing. And we can strengthen capacity, technology, and the availability of trade finance. The original multilateral logic behind the GATT negotiations, leading to the WTO, was the bargaining tariff. Even though it should be in a country's economic interest to lower tariffs and cut costs, political interests required trading off barriers that were defended by protected groups. A new trade facilitation and development agenda puts the self-interest of lowering costs of trading to work for the multilateral interest of encouraging more integration, efficiencies, and opportunities, meaning more jobs, more growth, and less poverty. As the exporters and importers do more business, they may be able to increase their voice for liberalizing negotiations too. This is multilateralism of practical steps, moving ahead where it's possible to do so. The new multilateral network must also interconnect energy and climate change. World energy markets are a mess. Producers, fearful of collapsing prices, are wary of new investments. Consuming countries want lower prices for consumers, but prices high enough to encourage conservation, efficiencies, alternative supplies, and new technologies. And the most vulnerable countries and people are victimized by the whole confusion, as they're hit by high prices, price volatility, and climate change. Most oil production is now controlled by national oil companies. These suppliers do not respond to market signals in the same way as private producers. We need a global bargain among major producers and consumers of energy. The International Energy Agency organized OECD consumers, but it didn't include all the rising powers. A few years ago, China suggested that the major energy consumers organize to deal more effectively with the producers' cartel. This is an idea worth considering, though with a broader purpose. At a minimum, such a bargain should involve sharing plans for expanding supplies, including options other than oil and gas, improving efficiency and lessening demand, assisting with energy for the poor, and considering how these policies relate to carbon production and climate change policies. Developed countries need to create and bring new technologies to market to help both developed and developing countries. Developing countries need to reduce costly subsidies and increase efficiencies while coping with social instabilities. And everyone should have an interest in preventing energy resources from triggering national security threats. Part of the bargain will be to provide an opportunity for developing countries to make longer-term investments to reduce vulnerability to high and volatile fuel prices while supporting the poor with safety nets. Energy access needs to be a critical complement to clean energy investments. Over 1.5 billion people in the world do not have access to electricity, including about 3/4 of the population of sub-Saharan Africa. At the request of some of our key shareholders, the World Bank Group is developing an Energy for the Poor initiative to help the poorest countries meet energy needs in efficient and sustainable ways. We might consider taking the bargain further. There could be a common interest in managing a price range that reconciles interests while transitioning towards lower carbon growth strategies, a broader portfolio of supplies, and greater international security. Multilateral understandings about energy futures, leading to clear pricing for carbon, might also be vital for the UNFCCC negotiations on climate change. Countries are fearful that in a world of uncertain energy costs, technologies, and supplies, a climate change treaty will limit their growth or flexibility to adapt. A bargain among key producers and consumers might counter these risks, making it easier to commit to cut carbon. A climate change accord will also have to be supported by new tools. We need new mechanisms to support forestation and avoid deforestation, develop new technologies and encourage their rapid diffusion, provide financial support to poorer countries, assist with adaptation, and strengthen carbon markets. 2 weeks ago, to help provide additional resources for these challenges, the bank hosted a pledging session that raised $6.1 billion for new climate investment funds. The steering group could help push action on energy, the environment, and financing to assist the UN negotiations and the practical implementation of a treaty. Nowhere is the new multilateral network more needed than in the fragile and post-conflict states where the bottom billion live. Too often, the development community has treated states blighted by fragility and conflict simply as harder cases of development. Yet these situations require looking beyond the analytics of a development to a different framework, building security, legitimacy, governance, and economics. This is not security or development as usual, nor is it about what we have come to think of as peace building or peacekeeping. Securing development is about bringing security and development together, first to smooth the transition from conflict to peace, and then to embed stability so that development can take hold over a decade or beyond. Only by securing development Can we put down roots deep enough to break the cycle of fragility and violence? Our appreciation of how best to secure development, to synthesize security, governance, and economics to be most effective, is still modest. We face critical gaps in international capabilities. Ultimately, the most important element in any fragile or post-conflict state is the people of the country. But it will take much stronger and longer-lasting multilateral assistance to help those people shift from being victims to becoming the principal agents of recovery. Beyond assistance, it requires new network relationships between peacekeeping forces and development practitioners, and a new approach to security. Next month, the United States will elect a new president. That president will need to move beyond the firefight of financial stabilization. Dealing with the economic aftermath will be one of the foremost responsibilities of the new administration. This work is not about America alone. Both candidates have spoken about strengthening the sinews of America's ties with the world. How the next American president does so will matter. Fate presents an opportunity, wrapped in a necessity, to modernize multilateralism and markets. Thank you.